If you don't start investing in 2026, you're slowly falling behind, not because you're irresponsible, not because you don't work hard, but because inflation keeps increasing, and cash sitting in a regular account loses purchasing power over time. 10 years ago, groceries were cheaper, rent was cheaper, gas was cheaper. Your money has to grow just to keep up. The problem is most beginners think investing is complicated, risky, or only for wealthy people. It's not. In fact, in 2026, investing is easier and more accessible than ever before. You can start with small amounts, you can automate everything, and you don't need to pick individual stocks to succeed. In this video, I'm going to walk you step by step through exactly how beginners should start investing in 2026 clearly, practically, and without hype. Quick reminder, this video is for educational purposes only and not financial advice. Investing involves risk. Always do your own research and consider speaking with a licensed financial professional before making financial decisions. Step 1. Build your financial foundation. Before investing a single dollar, you need stability. That means an emergency fund. An emergency fund is 3 to 6 months of essential living expenses saved in a safe liquid account like a high-yield savings account. Why is this important? Because investing is long-term. If your car breaks down tomorrow, if you lose your job, if you face a medical expense, you don't want to be forced to sell investments when the market is down. That's how beginners lose money. Not because investing fails, but because they weren't financially prepared. Savings gives you breathing room. Savings gives you confidence. Savings prevents panic. Think of it as the foundation of your financial house. Without a foundation, everything collapses under pressure. Step 2. Eliminate high-interest debt. Next, look at your debt. If you're paying high interest, especially credit card interest around 18% to 25%, that should be your priority. Here's why. If the stock market averages around 8% long-term, but your credit card charges 20%, you are mathematically losing money. Paying off high-interest debt is like earning a guaranteed return equal to the interest rate. That's powerful. Now, not all debt is bad. Low-interest student loans or mortgages may not need to be rushed. But high-interest consumer debt? Clear it first. This step alone dramatically improves your financial position before you invest. Step 3. Open the right account. Once your foundation is solid, it's time to open an investment account. In 2026, this takes less than 10 minutes online. You'll usually choose between a standard brokerage account, flexible, accessible anytime, or a retirement account like a Roth IRA, which offers potential tax advantages if you qualify. If your goal is long-term retirement savings, a Roth IRA can be extremely powerful because your investments can grow tax-free under certain conditions. If you want more flexibility, or you're investing beyond retirement, a brokerage account works perfectly. Don't overthink this step. The key is simply getting started. Step 4. What to invest in. This is where most beginners get stuck. They think they need to pick the next big stock, watch financial news every day, or predict market crashes. You don't. The simplest and most proven strategy for beginners is investing in low-cost index funds or ETFs. An index fund spreads your money across hundreds or even thousands of companies at once. Instead of betting on one company, you own a piece of the entire market. For example, total market index funds, S&P 500 index funds, broad, global market funds. This gives you diversification automatically. Diversification reduces risk. You're not relying on one company's success, you're investing in overall economic growth. Keep it simple. Simple strategies often outperform complicated ones over time. Step 4. What to invest in. This is where most beginners get stuck. They think they need to pick the next big stock, watch financial news every day, or predict market crashes. You don't. The simplest and most proven strategy for beginners is investing in low-cost index funds or ETFs. An index fund spreads your money across hundreds or even thousands of companies at once. Instead of betting on one company, you own a piece of the entire market. For example, total market index funds, S&P 500 index funds, broad, global market funds. This gives you diversification automatically. Diversification reduces risk. You're not relying on one company's success, you're investing in overall economic growth. Keep it simple. Simple strategies often outperform complicated ones over time. Invest consistently. You do not need thousands of dollars. You can start with $50 a month, $100 a month, $200 a month. What matters most is consistency. Set up automatic investing. Choose a fixed amount that fits your budget. Let it run every month. This strategy is called dollar cost averaging. It means you invest regularly regardless of whether the market is up or down. When prices drop, you buy more shares. When prices rise, your investments grow. Over time, this smooths out volatility and builds wealth steadily. Consistency beats perfection.
Common mistakes beginners make. Avoid these mistakes. Checking your portfolio every day. Trying to chase trending stocks. Panic selling during downturns. Investing money you might need soon. Investing should feel boring. Boring is good. Boring means steady. Steady builds wealth. Here's your simple 2026 investing plan. Build 3 tier 6 months of savings. Pay off high-interest debt. Open an investment account. Invest in low-cost index funds. Automate monthly contributions. Stay patient for years. If you follow these 6 steps consistently, you are already ahead of most people.
Investing is not about being perfect. It's about starting. Small steps today create massive results tomorrow. Thank you very much for watching the video through to the end. If this video helped you understand how to start investing in 2026, like, share, and subscribe for more beginner-friendly money content. Comment "Invest" if you're starting this year. Your future self will thank you.